So this week's commentary is inspired by a recent reading of Mary Poppins with my 3-year-old before bedtime. Some great market insights that apparently came out of a section of that story that I hadn't thought of before and wanted to share with you this week. So what is this scene in Mary Poppins that I'm referring to? Well, it's a scene where Mary Poppins and the kids head over to Uncle Albert's house, only to find him on the ceiling. And if you remember that scene, as you think happy thoughts and get euphoric, you rise to the ceiling. And if you think sad thoughts or have those brought to mind, you go crashing to the floor. It reminded me so much of how markets act, particularly of late, where again, we've been talking about this for some time. We've kind of been stuck between these ceilings and these floors. And what happens here is people, when you're in this type of environment, where you find yourself either bumping up against the ceilings or crashing to the floors, you get impatient. You get impatient, a little cabin fever, if you will, trapped in this room, and you start anchoring to various points in market history or your personal financial history to create a narrative that, again, fits the paradigm that emotionally, subconsciously, you're wanting to believe in. It's just not a useful way to invest. So point one here is around the dangers of anchoring. What is that anchor? Is it when you started investing? Is it a year ago? If we look at 3 recent ones that are of note, at least to us, when we started talking about the floors and ceilings back in late 17, and we shared this chart a couple weeks ago, until the last week or two, we had basically had little to no return over a year type time frame. We're now slightly positive after the strength of the last few weeks. But is it that range bound floor? Someone might have picked the 2018 highs, which again, from September until recently, still showed a negative number and losses. And for those of you who might have been holding some of those FANG stocks, you're still underwater from those all-time highs, in some cases 10 or 15%. Or is it the December 24th low, in which case you're up 15%? My point is, while you need to be aware of all these things, picking these arbitrary anchors to compare things to try to make judgments about what's to come is just not productive. So with respect to those anchors, if we move away from that, we look at, again, the modern context, where are we at right now? Well, we continue to believe in this floors and ceilings concept, obviously always within a much longer time frame uptrend, which the markets have clearly demonstrated over the decades. But I'm reminded of 2 meetings this week, one in which the gentleman's response to me was, well, you seem pretty optimistic, and one I had had a couple days before that where the guy said, well, you seem like you're kind of pessimistic. I think, my story has remained pretty consistent here over the time, that was in large part maybe an indication of where they had anchored to in terms of their outlook. To me, it's really both things. I am relatively optimistic, if you want to put it that way, in that I do think the floors continue to be not too far below our feet. Quite simply, it's a U.S.-led global economy, and that U.S. economy is led in large part by the U.S. consumer, and that U.S. consumer continues to be in great shape. We still see debt-to-income ratios at near 40-year lows, and we also, as we saw today, continue to see a really strong labor market, and albeit slight, an uptrend to wage growth. Around debt levels, because the one pushback I'll get on this is, I thought the U.S. consumer and U.S. corporations had record debt levels. Debt cannot be viewed in isolation. You need to view it in light of income and assets, and when you look at that, again, the U.S. consumer hasn't been this healthy in almost 40 years, as opposed to, again, the boom bust that we saw between the 80s, 90s, and 2000s, culminating in the Great Recession. So that's why I've got some optimism that we've got some constructive thought. That and global economic expectations are really bottomed out. There's really not a whole lot of place to go but up from there. What about these ceilings, right? For those people who might be getting really their fear of missing out, I would just caution this. We're trading at near 18 times earnings right now. You're seeing some tech stocks flying real high on CNBC this morning. I heard some people trying to justify Lyft's valuation with the idea, and the quote was literally, there are a lot of companies who don't make money. That reeks a little bit of that 2000 type mentality. I just, again, caution you that macro data is still slowing. We don't have as many tailwinds as we've had recently. Again, it's not a reason to panic, but it is a reason to keep your process intact. So what do we do here real quick? If you're in the distribution phase, look at income. If you were relying on total return last year, there was none to be found. 90% of asset classes were down. All the major indices were down 5%. You had to liquidate things at a loss. For those of you who had a correct income approach, not only did you see your income stay intact, Q4 had record dividend payouts on the S&P 500. Global equities rose by almost 10% in terms of their payouts. Of course, there are other asset classes, but that income not only was resilient, but in most cases grew in various asset classes. So the caution here would be, again, don't get too hung up on that fear of missing out, believing that there isn't a ceiling, at least a damper into this market, and start chasing getting capital appreciation focused as opposed to sticking to your plan, which is to have a good income stream. For those of you in the accumulation mode, which should be defined by either having enough money that you're not going to need that for quite some time, and or you're younger and have the ability to continue to throw a lot of regular contributions into your account, the caution here is don't worry too much about those floors, right? The markets are going to have volatility, but those are opportunities, again, to buy things on sale. So within this Mary Poppins, Uncle Albert weird world that we're living in, don't let these headlines that come out that make you either euphoric and bumping up against the ceiling or depress you and have you crashing into the floor whip you around too much. The yield curve that was dominating the headlines 2 weeks ago is already out as it's corrected itself back. North Korea and the U.S. tensions a couple years ago were going to end the world. That sense abated. Trade wars a year ago were going to be the end of the markets. Now they're actually a catalyst to the positive. It's a fool's errand to have too many weekends wasted worrying about that, but even to have it dictate your plan. And to that end, I would just caution two last things. Number one, where that you find yourself getting whipped around by those headlines too much, ask yourself, am I fixating on this because I'm avoiding addressing other issues maybe within my own personal financial life that need to be addressed? And two, outside of the normal emotional angst reaction to market movements, ask yourself, do I understand my plan well enough? Do I have enough confidence in my plan? Because again, some of those emotions may indicate that you need to either have a better plan or at least understand it better. I'm going to end it right there. Thank you so much. I look forward to seeing you soon.